Michael Darda, MKM Partners Chief Economist, Macro Strategist. Michael, good to talk to you this morning. We're coming off of what has been, a weaker than expected inflation print. We get the retail sales data today that shows consumers are still spending. How do you sort of connect the dots with the two?
Yeah, absolutely. So these were pretty strong figures on retail sales. As mentioned, even if we take autos and gasoline out, the numbers were still pretty strong, beating the consensus estimates. And with lower inflation, these numbers are actually positive in real terms. So that's good as far as it goes. Unfortunately, we also had some softer data released today. Industrial production and manufacturing actually missed expectations for October. And the NAHB Housing Market Index, a sentiment gauge, which is a leading indicator for housing, plunging to a new low for the year. Housing's been in a very severe downturn and tends to lead the rest of the economy. So it's much more of a mixed bag today in terms of the macro data. And I think the equity market response reflects that. The consumer discretionary sector is actually the weakest performer on the day today.
You crunch all those numbers together. I mean, what does that tell you about where we are in this cycle and to what extent the Fed's tightening is working?
Yeah, I think we're still in the growth phase of the cycle, but growth has been slowing. Certain areas of the economy have been resilient. The labor market obviously has been resilient, but the lagged impact of Fed tightening will continue to hit the economy as we move into 2023. And as the most recent Fed speakers out today suggested, they don't think they're done yet. So we're going to get at least one more rate rise in December, if not a couple more. And we haven't even seen the most recent rate increases ripple through the macro data yet. So I think as we move into 2023, recession risks remain elevated, and we should be prepared for weaker numbers.
Michael, you mentioned the reaction in the market today certainly reflects some of the caution that we are seeing in the markets. But, what's interesting is on the back of CPI, PPI, we saw a huge rally, sort of this expectation again where we were a few months ago that potentially with inflation maybe starting to show that it's cooling off a little, the Fed may slow or at least even consider a pivot. Are we kind of back to where we were a few months ago on that?
Yeah, I think it's an interesting dichotomy. So we had been anticipating a bear market rally, if you will, simply on the back of inflation peaking and rate hiking expectations also peaking and starting to pull back a bit. That is playing out, and that has been associated with a pretty powerful rally from the October lows in the broad indices. Not playing out today, obviously, but we'll see how far this can run. The broader problem for next year is that in a recession scenario, earnings are going to fall. And so lower market interest rates are only going to take you so far in terms of rallying equity markets. The earnings have to be there as well. And if the earnings aren't there, then it's going to be like stepping into an open elevator shaft for the equity market. And, that is a key risk factor for next year.
And Michael, finally, we have been hearing from a lot of retailers, obviously a big focus here going into what is typically one of the busiest times of year with holiday shopping. In some ways, they've been able to cushion, some of the losses they've seen by raising the prices. We've heard of trade downs, but the retail sales today pointing to the fact that people are still spending. At what point do those price increases that some of these retailers have imposed really start to catch up with the consumer?
Well, I think we've already seen a bit of that, playing out as this high inflation period has really eaten into income gains. And so in real terms, we've already hit a wall in terms of real household incomes. What we have to think about is a risk factor going forward, even with inflation starting to come down now, that is a positive, but we're going to be in a weaker aggregate demand environment as a direct consequence of the Fed's tighter monetary policies in order to see through the disinflation that the Fed is aiming for. And usually that results in a recession. No one can forecast that with perfect foresight, but all of the key indicators that would be flashing red going into a recession are flashing red. Inverted yield curve, banks tightening lending standards for consumer and business loans. We're seeing some weakness in the riskiest parts of credit, the triple C market. Money supply growth from very narrow to very broad, negative in real terms. And we talked about housing a little bit earlier. We have a 6-quarter contraction in real residential investment spending, and that tends to happen before recessions hit. Housing tends to be out front. So we've got some canaries in the coal mine here, if you will, on the business cycle outlook.
Before we let you go, Michael, can we talk about your dog in the back? This, by the way, is a favorite of the team because your dog is always so calm in the back.
He is. Yeah. As soon as he hears my voice, he goes right to sleep. He doesn't care whether we're in a recession or a bull market. It's always the same.
We're all going to take a deep breath, just like your dog there. Maybe take it all in stride. A nice touch on that live shot. Michael, as always, good to have you on. Michael Darda, MKM Partners Chief Economist, Macro Strategist.